Let's take a step back and talk about something that's quietly reshaping the entire global economy. The fate of the US dollar. In Washington, the mood has shifted from confidence to quiet panic. Officials know the dollar must be defended at all costs. That's why we're seeing this sudden rush of diplomacy. Trump crisscrossing Asia, holding meetings, striking deals, and tightening alliances. On the surface, it's all about tariffs and trade. But beneath that, the real mission is currency control, protecting the value and dominance of the dollar. When Treasury Secretary Scott Bessent visited Tokyo, notice what didn't happen. He didn't pressure Japan's central bank to raise interest rates. He avoided confrontation entirely. Instead, he focused on one thing: keeping exchange rates stable. The message was clear: the US needs calm in the markets. The dollar can't afford another freefall. Because if confidence in the currency fades, so does America's global leverage. And right now, that leverage is under threat. Year to date, the dollar has already lost nearly 10% of its value. If that decline continues, borrowing in dollars will become even less attractive. Around the world, nations that once relied heavily on US debt markets are now backing away. In just the first 5 months of 2025, foreign governments issued almost 20% fewer dollar-denominated bonds, the first drop in years. The message from emerging economies is unmistakable. If the dollar keeps weakening and trade tensions persist, they'll look elsewhere for funding. And that's exactly what's happening. Across the developing world, a quiet revolution is underway, one that China is more than happy to lead. The BRICS bloc is gradually stepping away from the dollar system, and China's currency, the yuan, is taking its place. Just look at Indonesia. The country recently launched its first ever offshore sovereign bond denominated in Chinese yuan, known as a dim sum bond. It's a small but symbolic step, a way to attract international investors without touching the US dollar. Indonesia's motivation is simple: survival. The country depends heavily on trade, and the tariff war with Washington is squeezing it hard. For years, Indonesia has sold far more to the US than it buys. Over $24 billion in exports, versus roughly $10 billion in imports. But Trump's new 19% tariff on Indonesian goods is designed to reverse that. Fewer exports mean fewer incoming dollars. Meanwhile, Indonesia has agreed to slash tariffs on American imports and purchase billions in US energy, farm products, and even airplanes. Dollars are now flowing out faster than they're coming in. This isn't just Indonesia's problem. It's becoming a pattern across Asia. As the US raises tariff walls, countries find themselves short of dollar liquidity. If they continue borrowing in dollars, a single market shock could push them toward crisis. We've already seen what that looks like. Argentina's recent meltdown was a warning. Once you can't access enough dollars to pay your debts, you're at the mercy of the IMF, the Treasury, and Washington's conditions. And so nations are looking for alternatives. The biggest beneficiary of this shift is Beijing. Around the world, governments and corporations are issuing more and more yuan-denominated bonds. These dim sum issues have reached 720 billion yuan, roughly $12 billion US dollars, up 8% from last year, and growing steadily since 2022, when the Federal Reserve began hiking rates. Trump's trade war has accidentally accelerated a major financial transition. By isolating trade partners, he's driven them closer to China, not just in commerce, but in currency. And the data proves it. Chinese exports rose by more than 8% in September, even as trade with the US collapsed. Electric vehicle exports are up 11%, semiconductor shipments 30%, and shipbuilding 40%. Asia, Africa, Europe, and Latin America are all importing more Chinese goods, and increasingly they're paying in yuan. It's not ideology, it's practicality. If you're already buying from China, it makes sense to borrow and settle payments in the same currency. The longer the trade war continues, the weaker the dollar's role becomes, and the stronger the yuan grows. Even inside China, the transformation is underway. Exporters and importers are abandoning the dollar at a record pace. In September alone, Chinese banks sold over $50 billion worth of foreign exchange. Businesses are repatriating their earnings and converting them into yuan. Confidence in China's currency is rising, and every uptick puts more downward pressure on the dollar. So why is Beijing letting the yuan strengthen? Isn't a weaker currency supposed to help exports? Normally, yes. But here's where Washington's strategy backfires. With tariffs as high as 30%, the price gap between Chinese and Western goods is still massive. Even a stronger yuan doesn't erase that advantage. Chinese products remain the cheapest option in a world desperate for affordable inputs. And Europe knows it too. While the US decouples, European giants like Mercedes, Volkswagen, L'Oreal, and Rémy Cointreau still depend on China for up to 40% of their revenue. That dependency gives Beijing leverage, because as long as Chinese consumers keep buying, companies will keep accepting payments in yuan. So, as this new trade war drags on, a new currency map is being drawn. The US is fighting to hold on to its dominance, China is quietly building an alternative, and Europe, caught in between, has no leverage left. The age of unquestioned dollar supremacy is ending, not with a crash, but with a slow, deliberate shift. One bond issue, one trade deal, and one currency swap at a time. Over the past year, one major trend has become impossible to ignore. China's financial decoupling from the West isn't just reshaping trade, it's starting to reshape currencies too. The renminbi, or yuan, is quietly gaining strength, and that rise could soon ripple across global markets. Between 2022 and 2025, the Chinese currency was crushed under the weight of rising US interest rates. Back then, global trade still revolved heavily around the dollar. America's higher yields pulled money inward, boosting dollar demand while squeezing the RMB. But that world is changing fast. Now, as trade barriers harden and supply chains split, demand is shifting toward the Chinese side of the equation. Every new trade restriction and tariff indirectly forces more regional commerce to settle in yuan. And if the renminbi strengthens just a bit more, say another 2%, it could unleash a massive domino effect. Hundreds of billions in dollar holdings could be dumped almost overnight as importers and exporters scramble to shield themselves from volatility. The process of de-dollarization, once a theory whispered by analysts, is now unfolding in real time. As the dollar loses ground, Chinese markets are starting to reap the rewards. A stronger yuan makes imported goods cheaper at home, driving up local consumption and giving Beijing more breathing room to stimulate its economy. But across the ocean, the story looks far less optimistic. The United States is entering another cycle of what economists call currency debasement, a polite way of saying the dollar is slowly eroding in value. Trump, proud of his tariff collections, often presents them as a victory for American taxpayers. Yet when you zoom out, those revenues barely scratch the surface of the real problem. The government's spending addiction hasn't slowed, it's accelerating, and the numbers tell the story. Customs revenue has soared, yes, a 153% jump, pulling in roughly $120 billion in tariffs. But the Congressional Budget Office's deficit forecast for 2025 remains unchanged, a staggering $1.8 trillion. The same figure as last year. Why? Because expenses continue to balloon across the board. Social Security, Medicare, defense budgets, and most dangerously, interest payments on the national debt. This is the era of what economists call fiscal dominance. The system is locked into a cycle where spending can't fall, debt can't shrink, and interest costs keep snowballing. And that leaves the administration facing two bad options: inflate the debt away, or let interest payments devour the entire economy. The math is terrifying. The US now spends about $1.2 trillion a year just on interest. That's nearly a quarter of every dollar in federal revenue gone before a single program is funded. It's the highest burden in 25 years, and it's doubled in only 4. Even with tariff income rising, it's not enough to plug the hole. Confidence in the system is slowly bleeding out. At the heart of this crisis are two forces colliding: reckless spending and stubbornly high interest rates. The 10-year Treasury yield is still hovering around 4%, and if it stays there, something eventually has to give. The only possible escape lies in a delicate dance between the Federal Reserve and the U.S. Treasury. Treasury Secretary Besan may have to rework America's debt strategy, shifting new bond issuance away from long-term notes and into short-term bills, the kind that mature within a year. At the same time, the Federal Reserve would need to slash interest rates quickly, maybe even aggressively, to keep the entire system from cracking. That's the only real off-ramp left, and that's why markets now expect the Fed to cut rates again, at least by 0.25%. Futures traders are pricing it in with near certainty, 99.9% odds. If that cut doesn't come, Wall Street could face another violent sell-off. But every rate cut comes with a cost. Lower rates mean cheaper borrowing, yes, but they also accelerate the very debasement investors fear most. It's a paradox. To save the markets, the Fed might have to destroy the dollar's credibility a little further. That's why money is still flooding into US stocks despite the obvious signs of an AI bubble. Investors aren't chasing profits. They're running from a weakening currency. Look at Nvidia, up another few percent even as valuations hit the stratosphere. The fear of holding devalued dollars outweighs the fear of a market correction. Meanwhile, the global landscape keeps shifting. China and Southeast Asia have just upgraded their regional free trade pact, expanding trade flows in local currencies. Each new deal pushes the yuan deeper into the global system and sidelines the dollar a little more. The United States, trapped between massive deficits and rising competitors, can only respond by spending even more, pouring subsidies into domestic industries to keep up. And that's the irony. The more Washington tries to preserve its dominance, the faster it erodes. Tariffs, bailouts, and stimulus can buy time, but they can't buy stability. The world's financial map is being redrawn, and no central bank can stop it. The renminbi's rise isn't just a currency story. It's a symbol of how global power is rebalancing. And as the US doubles down on its economic war with China, the dollar's decline is no longer a question of if, but when. So here we are, a world caught between inflation, decoupling, and digital bubbles. The era of easy money is gone, and what comes next might redefine the balance of global finance for decades to come. But what do you think? Will BRICS continue to reject dollar lending and push even harder for a parallel financial system? And how far will China go to expand its own currency influence? Let me know your thoughts in the comments below. And don't forget to like, share, and subscribe as we navigate through these extraordinary economic times together.